So the main things I'm going to cover in this video is just an introduction to investing, how to start, what to buy it, how to diversify your portfolio based off of allocation, and then at the end it's just going to be a glossary of different terms that many of the most popular ones that you should know about. I will say if you're one that's recently watched my videos, the style for this is going to be a little bit different because I'm going to be going along the PowerPoint that I've created. So the first thing I'm going to talk about is what is investing. Now, this basically means that you're using your money to buy assets like stocks, bonds, or real estate with the goal of making your money grow more and generate income over time. The best part about this is that it takes barely any time or energy to actually do. And if you are trying to retire, which I assume all of you have the intention to, being able to retire without investing, say you're having your money saved underneath your bed, it's not going to earn you anything. You're not going to be able to make money while you're living and doing other things for your life. And because of that, investing is extremely important. Now, the thing about the stock market is that there is some level of risk, but that is also why you can potentially get that nice return. But you do have to understand what you're putting your money into because you could be actually losing money if you don't do it properly. The other thing you could look at is if you have it in a savings account or if you have it underneath your bed in cash. There isn't much risk, but you're also not getting much reward. And if anything, you're actually losing money because inflation is eating away the purchasing power of your cash. And the last point about investing that's extremely important to understand is the power of compound interest, where when you invest your money and as you do it over time, it's going to grow. And as it grows, it has more money to then make more and more money off of it. There's a famous analogy for this called the snowball effect. And it pretty much means that when you start, say it's at the top of a hill, it's a snowball and it starts rolling down. It's small at the top, but as you continue to do it over time, it gets larger and larger. Same effect, but now with your cash. So all in all, this concept is extremely important because it allows your money to earn more and more over time, leading to exponential growth on your money because there's no limit on how far your investments can go. So now that you understand the stock market and the power of investing over time, here are the main types of investments, starting with individual stocks. And this is when you invest into an individual company by purchasing shares of that specific company. So this could be Apple stock. You buy one share of Apple stock at $100. You are theoretically an owner, part owner of Apple stock, of Apple. But that is by buying one individual stock. There's a lot more volatility in this because the price could rise or fall significantly, much more than it would with an ETF, mutual fund, or index fund. These are pretty much a way to invest into many stocks all in one purchase. So I've made an entire video explaining these in more detail, but with ETFs, it's pretty much a 2, 3, or 4 letter ticker symbol where you can see VOO or VXUS. You can get this where it's actively managed by a fund manager. So if you are investing your money into an ETF, there is someone that is picking these stocks that are inside of this fund and removing them, changing them. That means that it's actively managed. This is more than likely going to be more expensive. It's going to be called the expense ratio, and that's how much it costs to own the fund per year. Where on the other end, you could get ones that are passively managed, and that means that they are tracking an index. Famous one that's known is the S&P 500. That's roughly 500 of the largest companies that are listed on the US stock exchanges. When you invest into a passively managed ETF, it can also be called an index ETF. So the benefit of getting a passively managed ETF compared to one that's actively managed is that it's going to be much cheaper, and the same concept follows with mutual funds because there's ones that are actively managed and ones that are passively managed by an algorithm. The passively managed ones are obviously going to be cheaper. The biggest difference between ETFs and mutual funds is that with ETFs, you can purchase them on nearly any platform. Say you're on Fidelity, Vanguard, Webull, it doesn't matter. You can purchase an ETF on nearly any of them. On top of that, ETFs also trade similar to stocks. And then when you look at a mutual fund that is also a bundle of different companies all in one purchase, but the difference here is that the trade doesn't go through until the end of the market day. And if you want to purchase the investment, you need to buy it on the platform that it's held on. So say it's a Vanguard mutual fund, you need to buy it on Vanguard, unless if you want to do it on a different platform like Fidelity, you have to pay a high fee. The way I like to look at it is that if you're getting an investment fund with 2, 3, or 4 letter ticker symbols, that is more than likely going to be an ETF. And then if you're getting one that's 5 ticker symbols, that would be a mutual fund. And then index fund is pretty much an ETF or a mutual fund. Hearing the word index just means that it's passively managed. You can buy a passively managed ETF, which is an index ETF, or a passively managed mutual fund that is an index mutual fund. Now that was obviously just a brief overview, but some of the different types of stocks you could invest into would be dividend stocks, which are ways to get into companies that pay regular dividends to its shareholders. And by doing this, you're pretty much able to get a source of income because a company is paying some of its profits to you to thank you for owning the stock. The next one is a growth stock, which is pretty much an individual company that you're relying on and hoping to get above average returns so that you can make more money and outbeat the stock market. The next one would be value stocks, which are pretty much companies that, determined by intrinsic value, which is the company's fundamentals, as being undervalued by the market. And by getting into companies like this, there's a lot of potential for the price to appreciate. So the next stocks are going to be based off of their market capitalization, which is the size that they are valued at on the market. And that could be between small, mid, and large cap stocks. There's many other ways and many other names for different sizes, but that's just the main view of looking at them. You then have the popular name of blue chip stocks, which is basically a way to get financially stable, really good companies that are large and have historically done very well over time. And that would be just to get a blue chip stock, and a popular one like that would be Apple or Microsoft. Other options you could look into would be international or global stocks, preferred stocks, which are basically a hybrid between stocks and bonds that can provide you a fixed income as well. You could also look into cyclical and defensive stocks. So if you get into cyclical ones, they're going to be more sensitive to economic cycles, hence the reason for its name. And then defensive ones are going to have less volatility based on economic performance. So if there's a large downturn, defensive ones should not be as volatile. They should not go down as much as something that would be cyclical. And although there are more to discuss, the last one is penny stocks, which are pretty much ones valued less than roughly $5 per share. That's not necessarily the main concern, but more so the fact of the value that they have on the market is going to be really, really small. And when you invest into these companies, you're hoping for a high return because there's a ton of risk by investing into them, but you also have to be aware that you could lose a lot of money because of that, which is something I've learned, and I've been avoiding penny stocks ever since a few years ago when I did not do as well as I wanted. But remember, there is a chance for high return, but there's a lot of risk that comes along with investing into penny stocks, which that is a huge reason why I transitioned into index fund investing, because the hard-earned money that you make, you want to invest and know it's getting put into something that is not going to lose all your hard-earned money. Going forward with that, let's now go over the types of ETFs. There are equity ETFs, which a popular one would be the S&P 500. You can see a ticker, for example, is SPY. And this tracks the S&P 500 index, which represents 500 of the largest US companies. And the decision on this and in the index is based on equity. It's based on large cap size companies. Going forward, there are bond ETFs, and you can see right here an example is LQD, and you're going to get exposure to a diverse portfolio of different types of bonds. And this is all in one purchase, and you can easily buy or sell it with an ETF, where if you go to get actual bonds, you're going to be, for the most part, depending on the bond, locked in for a certain period of time. So this has much more flexibility, but there are pros and cons to getting these. You could then look into commodity ETFs, which are a way to get different types of commodities. So you can see right here, gold trust, GLD is an option you could look into. Then there's sector ETFs like the technology sector, XLK, that focuses on one specific sector within the S&P 500 that you could track and actually monitor and invest into. Another option would be dividend ETFs, which is pretty much a way to get into many different dividend stocks all in one that can give you a dividend yield where you can earn a dividend income while ideally investing into these dividend stocks that are large companies that are performing well in the US economy where it can grow while still giving you an income. So you can get a little bit of both. A popular example of this that I wrote down is the Vanguard Dividend Appreciation ETF with the ticker VIG, but one that I love and have been talking about on my channel is SCHD, the Schwab US Dividend Equity ETF that historically has done extremely well and gives out a high dividend yield by investing into extremely strong dividend earning stocks. From there, the last one I want to mention is international ETFs. If you want to get into companies that are outside of the US, the easiest and best way, in my opinion, is to gain exposure through a fund that tracks them. Vanguard's Total International Stock ETF, VXUS, is a good example. They historically have not done as well as investments like the S&P 500, but they are a good way to add exposure to your portfolio, but I would keep it at a minimum. Moving on from there, you could look into the different types of mutual funds. So you have the equity mutual funds, bond mutual funds, money market funds, target date retirement funds, which are pretty much a way to, if you want to retire around the year of, let's say, 2050, it will allocate that specifically for you and your age and what you should be diversifying your portfolio for. And the closer it becomes to that year, the more conservative it will become. Another type you could get are dividend mutual funds. You can see there Vanguard's Dividend Growth Fund and international mutual funds. So you can get both of the same styles in both ETF and mutual fund, but I highly recommend, based on the tax structure of each, if you are looking to invest in a taxable account, to go with ETFs. And if you're in a tax advantaged account and you like the mutual funds more, go with that. If not, you can also get ETFs. So now that you understand a little bit more about the stock market and the different types of investments you could get into, you first have to understand what is your plan and actually think about it before you get started, because you got to think about your retirement. Is that what you want to prioritize first? Do you want income? Do you want to go for dividend income or any sort of producing assets that can give you a cash flow? Do you have an emergency fund? Are you going for short or long-term investing? What kind of investor are you? What are your goals? Are you under 18? If so, you're going to need a custodial account. Have a parent, legal guardian sign you off. What are your savings looking like? How much are you able to do weekly, monthly? You need to understand what are you saving and how much before you can actually invest, because if you're just investing all your money and then you end up having to sell a stock, you could get screwed. And then also, how are you investing? Because if you are going for the penny stocks, it'll be a lot more risk. There'll be potentially a lot more stress. You could lose a lot more money, and we're talking about the money that you worked hard for. So the first accounts I want you to understand that are really important to know about, because there's tax advantages to them, and this is also a great way to actually lead into your retirement successfully. Even though if you're far away, it's still a very smart thing to think about in the present day. So to get started, a traditional IRA is basically an individual retirement account. You can invest however you want in this account, and you're going to be able to get a tax deduction on the year up front with whatever you contribute into the account. And once you invest, you can do it however you want, and you're not taxed on the actual investments and throughout the growth of owning and having the account. But on the back end, when you're completely done, you have to pay taxes on the withdrawals. And once you're in the ages of 70s, there's RMDs, which are required minimum distributions. You're gonna have to withdraw from the account. You were forced to, and that's why I like the Roth IRA, because you're never forced to. The difference is that with a Roth IRA, you pay taxes up front on whatever you contribute into the account. I made videos on this if you want to check it out. Links are in the description. And then through the years of investing into this account, you're not taxed on any of the growth. So you paid taxes up front. You're not taxed in the middle of the years of you growing this account, and you're not taxed on the back end. This kind of account is crucial to understand because yes, you pay taxes now, but anything after does not get taxed. And if you're investing now and you're doing it consistently over time, and it's growing and growing from the concept of the power of compound interest, that snowball effect, as it grows, the ideal scenario is that in 20, 30, 40 years, it can grow significantly, and then it'd be all completely tax-free. And if you do it properly, you could have over $1 million completely tax-free. It sounds crazy, but it'd roughly be about $500 a month for 30 years straight. And that would be assuming you invested into the average stock market return like the S&P 500. So there's a lot of hypothetical scenarios, but historically that is proven to do very well for many investors that have stuck with it. The next account is a 401k. This is basically through your employer. They may offer you a match, which if you can take it, definitely take it, because that's pretty much free money. And if you want to get the Roth 401k, or if you were able to, I would highly recommend that, because that's the same concept of getting the tax up front. You pay it years during, and at the end, you don't have to pay it. The traditional 401k, you don't have to pay taxes through the years. So the beginning, it's nice, but the end, you pay all the taxes. So if you grow this account huge, then you got to pay taxes at the end. It's like, really? The next account is if you're self-employed, to consider looking into the SEP IRA. Then there's an HSA, which is a health savings account. I like to think of this one as a health retirement investing account. This is crucial to understand because this is a triple tax advantaged account. The front end, you're getting that tax deduction. During the years of growing, you're not taxed. You can invest this account however you want, by the way. You can buy whatever investments you'd like. It does not matter. Then at the very end, you are not taxed as well. That is all assuming with this account that you use it for qualified medical expenses. So if you can take advantage of this account, I would highly recommend it. The 529 plan is the exact same type of structure as the health savings account. So at the beginning, you get that tax benefit. During the years of growing, you don't get taxed. At the very end, you don't get taxed. Triple tax advantage. But the thing is that with this account, you have to use it for qualified education expenses, where the HSA is qualified medical expenses. Both may be necessary, so if that is for you, consider looking into these. And then the last option is the 403b, and this is pretty much like the 401k. There's some differences, but this is more so for someone with a career of like public schools, and it's when you can't take advantage of the 401k, you may be offered a 403b to utilize. So that about wraps up retirement accounts. If you are investing into a regular brokerage account, which is just a normal investing account, you can do this on any platform. So there's ones like old school brokerage firms like Fidelity, Charles Schwab, Vanguard. You could also look into ones like Webull, where I have a link that you can get free stocks if you decide to sign up. I'll have that link in the description below. But these are platforms that you can pretty much have a regular investing account. And if you want to learn about the taxes for investing in the stock market, I made an entire video on that. I also believe that if you're looking for retirement services, to go with one of the old school brokerage firms, that would be Fidelity, Vanguard, or Charles Schwab. It's a personal opinion of mine, and I'm not affiliated with Fidelity, but they are my favorite that I use for my own Roth IRA. If you're one looking to get a normal taxable account, I'd recommend also getting into Webull. You get that minimum of $60 of free stock if you use the link below. You can also invest on SoFi, and you can connect it with a high yield savings account. If you have your money sitting under your bed or you're not making any interest on your savings, go with SoFi because you can earn much more interest from the cash that you have sitting. You can earn up to a $325 cash bonus. And then once you have that set up, you can also link it to an investment account on their platform. So check those out in the description below if you are interested. Moving on from there, I'm not a financial advisor, but I'm just going to inform you on the different types of investments that you could look into and actually buy yourself. And the first one would be S&P 500 index funds. You could look into Vanguard's, which is VOO, the SPY, iShares, which is IVV, or you can get the mutual fund versions if you're on either of these old school brokerage firms. That would be Fidelity's FXAIX, Vanguard's VFIAX, and the Schwab's SWPPX. If you want to pause the video or download the presentation I have linked in the description below, you can do that, but here's a lot of the data that you can look into. I really like VOO for any platform, and then for my Fidelity Roth IRA, I really like FXAIX. And the reason I condensed this all into one image is because they're some of the most important things to understand. How many holdings are in the fund? You can see it's pretty much the same. The expense ratio is the expense it costs you per year to own it and to keep this fund active. Then 10-year returns. How well has this performed over the past 10 years? If it has that long of data or longer, that's really good to see. The dividend yield, I reinvest it, so it's not necessarily a big deal to me. But if you want to take dividends, that's what you would earn. And then the turnover ratio is how often are the investments inside of the portfolios changing. Moving on from there, some of the most popular international funds that you could look into would be Fidelity's Total International Fund, which is the mutual fund version, VTIHX. You have the Zero Fee Fund, which is the same kind of mutual fund, but there's no expense ratio. That would be FZILX. Vanguard's would be VTIAX. And then they have the ETF version, which is VXUS, that you can buy on any platform. And the same thing with the iShares Total International ETF, IXUS. You can also buy that on nearly any platform. And then if you're on Charles Schwab's platform, you could buy their mutual fund, which is SWISX. I know this is a ton of information, but if you seriously have a specific area that you think you want to learn more about, look into the description of this video because I may have gone into extreme detail on that particular section of the stock market that you may be interested in, like the tax example. I went into a lot of things about taxes in the stock market, just to name something. Index funds I've done a lot on too. So if you're interested, check out those links in the description below. Now look into international funds, you can see this is the only one highlighted yellow that has not had a full 10-year returns, but for many of them, they're around the 4 to 5%. So they're obviously not as good as the S&P 500 index options, but it's just a way to have a little bit of exposure to international markets. Some don't even want any, but I would prefer to just have a little bit just to test it out. So going forward with dividend funds, if you want to get a fund that tracks a bunch of dividends, make some income from that, and have more likeliness of actually achieving success and growing the portfolio as well, you may be interested in looking into these. The Vanguard Dividend Appreciation ETF VIG, VYM, Schwab's famous SCHD, the iShares DVY. Then you can look at SDY and the mutual fund on Vanguard that is VDADX. If you want to learn more about the specific investment, you can pause the video. And I just want you to be aware that the data is as of the market close of September 15th, 2023. Then other options we have are bond funds. If you want to get different ones, there's VBTLX, BND, LQD, Fidelity's mutual funds, FTBFX, FXNAX, and then Schwab's mutual fund, SWAGX. The main things I noticed with these is that there's a lot of holdings, so they're very diverse with many different types of bonds, but over time, historically, they do not do well, especially when you compare it to anything. Now, before I go on to explain the different types of portfolios you could build based on your risk tolerance, there are many different ways that you could actually submit an order to buy a stock or fund, with the main ones being market or limit order and a few more thereafter. So here's an example of getting Vanguard's S&P 500 Index Fund VOO through a market order. You can see on the right that it says order type is market. The price is now at $408.74. This is the default, and when you pretty much go and preview and submit this order, say you only want to buy one, when you go and hit preview and submit, it will immediately execute if the market is open, and the price that you get it for should be very close to what you're seeing when you submit the order. If the market's closed, it's going to execute as soon as the market opens. And then a limit order is basically a way to specify a price point at which you want to buy or sell the investment. So you can see VOO is at $408.74. Let's say that you don't own it right now, or maybe you do, but you want to buy one more share of it. You could put in a limit order and you specify the price. So let's just say $405. That means if the index fund goes down from $408 to $405, that will trigger the limit order, and it will actually purchase it automatically for you, even if you're out doing something different and you're not actually buying it right on your table. But the thing to know is that if the index fund were to continuously go up and it never went down to $405, the price, the trigger, it would not go through. You would never end up actually purchasing that particular investment. So that's just a simple way to buy your investments on the stock market. If you are looking to actually build a portfolio, there are different types that you could do based on your risk tolerance. These are just generic guides. They're not what I do, and they're not what I'd recommend you doing. They're just so that you can get a good understanding. You can see right here, there's 15% domestic stock, 80% domestic bonds, and 5% international stocks. The type of person that would do this would be someone who's retired, that isn't really working and making money, but they're more so relying on their savings to keep them going. And just so you know, I'm going to be using this portfolio as just the generic explanation, but there are 3 index funds that I'm using for the entire portfolio, but they're very broad. There's a lot of exposure by investing into these 3. The first is the Vanguard Total Stock Market ETF, VTI. That's going to get a lot of exposure in the US. The Vanguard Total International Stock ETF is going to get a lot of exposure outside of the US. And then the Vanguard Total Bond Market ETF is going to get a lot of exposure into bonds. And I just want to give you a good idea on how each of these portfolios I'm going to show you would have performed. And from 2012 to May 2023, that is an 11-year study. It would have averaged a 3.39% annual growth rate over that time, which means $10,000 in 2012 would now be $14,600. Moving forward from there, there is the moderate portfolio, which would be 1/3 equally split into each domestic stock, domestic bond, and international stocks. I don't recommend this. I actually would have at most 10-15% in international exposure. So the international one is a bit more on the not balanced side of what I would do, but this is just a generic approach. And if you look at the average returns, that would have gotten a 6.7% annual growth rate over the 11 years. That would have turned $10,000 into $21,000 from 2012 to 2023. Then the generic aggressive portfolio, which I'm way more aggressive than this, but that would be to have 65% domestic stocks, 20% domestic bonds, 15 international stocks. And with this portfolio, you're theoretically taking on a bit more risk, but you're able to get more of a return. And as you can see right here, there is an average of 9.55% per year over the 11 years, and that would have helped your $10,000 grow to $28,320. So personally, I'm not a huge fan of those, but that's also because of my age right now, and I'm able to take on more risk. I don't have many liabilities, and because of that, I am more on the aggressive side, and even a little bit more than this. But using this portfolio of the very aggressive portfolio, 80% domestic stocks, 5% domestic bonds, 15 international stocks. So this portfolio would have actually generated an 11.6 annual growth rate over 11 years, and that would have taken $10,000 sitting and turned that into roughly $36,000. And that is a huge improvement for having your money sit and not touching it at all or doing anything. And I just mentioned that because if you were to add more into this kind of account over time and invest continuously, the numbers from continuous growth would add up tremendously. Now, I just want to show you a hypothetical example of the power of compound interest and what it would be like if you did this over time and you achieved that 11.6% return, although it's not adjusted for inflation. It's just hypothetical, and that is assuming that, let's say you maxed out your Roth IRA. That's $7,000 per year. Let's say you're 30 and you do that until you're 60. If you average that 11.6% return over the next 30 years, your portfolio would grow to be almost $2 million, and all you would have contributed was $217,500 $100,000 into the account. You would have made over $1.5 million just from the fact that you let it sit in investments instead of under your bed or in a savings account. Now that was obviously hypothetical, but let's just say that you did this and you averaged 9% per year over the next 30 years, which is definitely possible. That would still have generated your portfolio to be over $1 million. And if this is in a Roth IRA, that can be completely tax-free. So that about wraps up the video on stock market investing. I hope this helped you out. If it did, I'd really appreciate you hitting the like and subscribe button. Here's the glossary if you want to learn more about different types of words, popular terms that you should know about. You can download the PDF to learn more about them or pause the video as I'm doing this. Don't forget that if you want to start investing and you sign up using the link I have in the description below for Webull, you can get over $60 worth of free stock when you make your first initial deposit. And like I said, if you're interested to learn more about the stock market, I highly recommend you look at the videos I have on my channel. I have so many, and if I tried to get all the stock market into one video, it would have been 20 hours plus. So hopefully this covered a good amount in the short period of time. And if you want to learn more about a specific area, I highly recommend you check out that free content. With that said, if you want to see how I allocate my investments or you need additional assistance with building an investment portfolio, check out the links I have in the description below. I think you could greatly benefit from that. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.